That's an exact number that I actually gave through. So tell us how you exactly got to that number.
Oh, through massive deliberations and a great intellectual exercise to arrive at that number. But I think, you know, the bottom line is we're still bullish on gold. And, you know, I'm still perplexed when I come to South Africa and people accuse me of being bearish. And, you know, I think the economic backdrop is still pretty conducive to higher gold prices. But, you know, there is always a risk, and this is the thing I've been highlighting for a number of years. There is a material risk of some downside risk at some time in the future. But in the short term, if you've got a 6-month time frame, I think you're pretty sure to see higher gold prices than lower gold prices.
Okay, so is this based on a lot of the fundamental factors that we see, that central banks are still net buyers, that we're still seeing a lot of physical demand coming through, and then also, or you're also taking a look at the possibility of more stimulus globally?
Well, I think to answer your last point first, I mean, the premise of our view is absolutely towards the end of this year, the economic data that's coming through the US is not going to be positive. And that's going to suggest QE3 again, a whole raft of economic and monetary measures to address this, and that's going to be positive for investment in gold. As long as we see an environment of negative real interest rates in most of the macroeconomic jurisdictions, the United States and elsewhere, we're going to see gold prices go higher.
So you are relatively bearish then?
Well, I think the bearishness will come about when we see things change on the interest rate cycle, and that's got to be a long way away. We're not going to see that turning the corner for at least another year, in our view. Of course, the downside risk and the sort of outside risk that one has to countenance here is that in the next 6 months or 12 months, the green shoots of recovery that people got pretty excited about in the United States turn out to be real. I find that very difficult to believe, but if they do turn out to be real and we don't see QE3, I think gold's got a real hill to climb.
Let's touch on what we see in the Eurozone and what risks you foresee there. It seems that Greece is now tucked away neatly because they've just received the next bailout package. Spain under the spotlight, Italy under the spotlight. Is there a concern from your end with regards to what could play out there and how that could impact gold? Because that's also been one of the big catalysts, one would think.
Sure. And, you know, I think the issue here is how the US and Europe play between one another over the next 6 months. Does Europe have an impact on the United States? It's impossible to believe it won't. But there is also another outlier here, is what happens in China and India. We see slowing growth in those markets. I don't think the macroeconomic backdrop, wherever you look globally, is a particularly positive one. And as long as that remains true, then the Fed and the European Central Bank are going to have to keep interest rates anchored. And I keep on repeating this point. Gold is about interest rates. It's about
the cost of holding gold.
It's the cost of holding gold. It's opportunity cost and the search for yield. And if you narrow it down, people tell me it's about the strength of the dollar, it's about safe haven buying and so on and so forth. I don't believe that for a moment. The primary underlying driver of what we've seen in the gold market is about interest rates and people searching for yield. And you can't get yield in many other parts of the world that we would have, you know, property, for example, in the 2000s was a good place to park your cash and get a return. That has disappeared. Bonds, you know, we're in the midst of a bond bubble. People still buy bonds because they have to. Funds have to buy them, they have no choice. So that will continue for a while. But eventually this will turn. But at the moment, we're in a situation where people are searching out yield, and gold is a great yield generator.
But some would argue against that because they say, well, I've got to pay to hold gold.
Yeah,
so
but the yield is not in terms of an interest payment against your gold holdings. It's in the capital appreciation. And mention another asset class on the planet that's performed as well as gold in the last 10 years. You'd be hard-pressed to find one. Maybe fine wine, and that's a kind of asset class that's also actually benefited from low interest rates, in my view. People are looking for yield, and they'll eke out yield from ever obscure investments, and that's why Bordeaux has performed as well as it has over the last 3 years. Gold has been a recipient of it. It's not special. Property was a recipient of those kind of investment inflows in the 2000s.
Gold is not sitting in a bubble right now, and you believe that it's going to go much higher. We talk of 1.7 odd, you know, going forward this year. What about 2000? We even have someone, you know, coming onto this desk, Chris Hart from Investment Solutions, talking about gold hitting $5,000 an ounce, you know, in a few years' time. What kind of upside do we actually have? How much higher can it go?
Well, I think the upside is probably around about $2,000, as we've stated in our publication. I can't believe that we're going to see it go materially higher, because for that to materialize, we're going to have another bull rally in gold for the next 2 or 3 years. Sooner or later, the interest rate cycle is going to change. And as soon as the interest rate cycle changes, as soon as we move to a positive interest real interest rate environment,
gold fall off a cliff?
Gold will fall very, very dramatically when that comes about. But that could be another 2 years. It could be 3 years. I mean, the whole thing about calling gold at the moment is your call on the United States, Europe, China. Do we have a bubble in China? Undoubtedly we do. If that does implode, how does that impact Europe and the United States? I think that suggests to me that there's still positive upside for gold because we're not out of the economic woods yet.
So gold mining companies should take advantage of the current gold price as well at this point?
Well, you
in
know,
time.
there's a point I was making yesterday in my presentation. Again, I'm not an evangelist for hedging. What I'm an evangelist for is sensible, rational thinking about markets. And this is what we've been doing.
At what point should gold mining companies hedge?
Well, you know, this is a discussion they should have with their shareholders. What are they looking for in terms of dividend yield? What are they looking for in terms of capital appreciation? And most importantly, what do they want to protect themselves on the downside? And there is real material downside risk for miners. In the case of South African producers, if the gold price were to fall sharply, what's the prospect for a South African gold mining equity? You know, you're looking at a zero bound on the lower side, and that is where, you know, you could see equities falling to if you do see gold prices falling sharply. So it's a conversation.
But that's a long way away because
well,
interest rates.
Well, is it a long way away? I mean, is it, you know, we could be surprised. I mean, the one thing we have seen in markets like Greece, for example, is that yields can move very quickly and very sharply. And unless central banks are willing to just stand behind this and pour massive amounts of liquidity into these markets across the yield curve, what happens if you see US dollar interest rates move sharply? At the, you know, they can anchor them at zero for the rest of history. You know, that's their brief. They have the power to do it. But what happens if you start to see the bond market saying, we don't believe this is credible, we don't believe this is sustainable, and interest rates at the longer end move? Trust me, at 6-7% 2-year US dollar yields, gold really does have a problem. But it's probably quite some way off, at least a year. But in the gold mining industry, a year is not that long a time.
Absolutely.
Most of these mines have 20-year time frames.